What do you make of the argument that we're hearing now? This is all about raising that revenue for the tax cuts and helping the working man. And big rich guys like you just got to suck it up, Johnny McNiff, because you've been at the trough long enough. Let the rest of us eat.
One, I think there's one rich guy in this conversation, and it's not me. Two, the tariffs are inherently a regressive tax hike on the working class. That's a fact. Everyone's price of goods, yours, mine, everyone watching the show right now, went higher the past weekend. That is a tax hike on the U.S. economy. That's the only thing certain about these tariffs. All of the other plans about long-term investment, benefit to the worker, that is all uncharted territory. You highlighted a great point with Apple today around them moving their production to India versus China. They did not obviously say we're going to start and open up a new plant here in the U.S. So the only thing that I know right now is that the U.S. consumer and households are worse off. The balance sheet for U.S. corporations is also worse off. 40% of revenues for the S&P 500 come from abroad, right? So you just tax that as well.
So, but you're a bunch of pigs. And what we're going to do here is create a better rate environment for us to refinance our debt, and that helps the American taxpayer. And those revenues that the tariffs bring are going to extend the tax cuts, and they put more money in all Americans' pockets, which is why Trump's economy in the first term was the best ever.
Okay, a couple of things here to unpack. First, in terms of rates, Scott Bessent has made it a point that getting the 10-year Treasury yield lower is a priority for the Trump administration. And that is where a lot of financing occurs within, whether it's in the mortgage market, corporate market, et cetera. So focusing on that would provide some relief to the U.S. economy. However, it's a huge liquid market. The issue that we're having right now is we're in a period of what is very much everyone's considered stagflation, right? Where we have persistently high inflation post COVID and low growth. The tariffs have hurt economic growth. Estimates right now from Wall Street are it's going to put a negative 1.5% drag on GDP and a positive 1.5% rise on the consumer index CPI. That is stagflation. That puts the Fed in a very tough spot, whether they can lower rates anymore, and watching how the economy unfolds, because they have a dual mandate of a higher employment as well as inflation. Their inflation target is 2%. It's currently running about 2.8%. So there's not a lot of room for that scenario to really play out. Secondly, right now the world order is the U.S. is the reserve currency. It is the global head of the markets. We are fracturing our economic relations. You saw today, the Treasury market, particularly the long and 10s and 30s, rise 20 basis points. It is a big liquid market. If you see foreign countries, which are large holders of U.S. debt, start to sell, that's going to put pressure on high-end and longer-term yields as well. So there's a lot of moving parts in this. I think the Trump administration has tried to make this like an elementary math equation, where 1 + 1 = 2. Do the tariffs and you get these positive effects. The reality is this is a lot of butterfly effects that can occur here. And you're seeing a lot of disruption in kind of the world order that we've had in the past in terms of geopolitical and economic ties. And all of that is changing. And it's really hard to predict how it's going to play out.
Hey, thanks for watching. Go to joinnn.com to find NewsNation on your screen. And don't forget, click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.